Hi, it's Nick Jevick again with Trans Capital Pro. We've got another private placement tutorial. Today we're going to talk about how to price your warrants. One of the most frequent questions I get is, how much equity do I need to offer? If you offer too little, your deal doesn't get done. And if you offer too much, you're taking unnecessary dilution. So I've got a real simple process on how to price your equity offering, or really how to price your warrants. It's so easy that you can do it on the back of an envelope, really. What you'll need before we begin is how much equity you'll need, a base case forecast for your business, structure and terms of your offering, an idea of the valuation metrics for your type of business, and a targeted IRR that your investors are seeking. So first we'll have a couple of definitions. Second, I'll go over the 6 basic steps. And then finally, I'll go over an example with some real numbers so you can see how it all comes together. So definitions. First, enterprise value is not to be confused with the equity value. The enterprise value is the gross value of your business. And so when you hear someone tell you that their business is worth 5 times or 6 times or whatever, what they're conveying is the enterprise value of their business. The equity value is the value of the common equity or membership units if you have an LLC. And it's a simple formula. It's equity value is equal to the enterprise value, less the debt, less the preferred stock, plus unrestricted cash. And you'll notice that if a business is worth 5 times cash flow, but there is debt at 5 times cash flow, then the equity value is essentially 0 or whatever cash there is on the balance sheet. So here are the 6 steps. Number 1 is you come up with a base case projection over the investment period for your company. Number 2 is structure and terms of your offering. So you'll need to know what type of security you're offering, what the dividend or interest rate is, whether that dividend or interest rate will be cash pay or accrued or some combination thereof. Number 3 is a terminal enterprise value, meaning that it's a projected enterprise value at the end of the investment holding period. Number 4 is the terminal equity value. So if we know what the enterprise value is and we can forecast what the debt and the cash will be, we know what the terminal equity value will be. And so here, with respect to the forecasted debt and cash, it's really best to use some kind of financial model to be able to dial in those numbers. Number 5 is the warrant dollar amount. So this is the amount that needs to come from the warrants so that you can hit your targeted IRR for your investors. And this is what we're trying to figure out. And then finally is the warrant percentage. So what percentage of equity does the warrant convert into? And it's simply the amount that's calculated up in step 5, up above, divided by the equity value that we got from step 4. So let's go into an example. And so here are our assumptions. We've got a business with a current EBITDA of 1.3 million. And with the capital that's being raised, that EBITDA is projected to grow at an 8% compounded annual growth rate to 1.9 million by the end of year 5. We're forecasting that the debt outstanding and the unencumbered cash by the end of year 5 are projected to be $3.25 million and $150,000 respectively. We're going to be issuing $1 million in preferred with a 12% current pay dividend, and the overall return expected by our investors is 35%. And that the business in this industry with this kind of profile typically is valued at between 4.75 times to 5.25 times EBITDA. So steps 1 and steps 2, from our assumptions, we've got a business that'll have $1.9 million in EBITDA by the end of year 5, with $3.25 million in debt and $150,000 in cash on the balance sheet. We're going to be issuing $1 million of preferred with a 12% current pay dividend. Step 3 is the terminal enterprise value. So here we know that the projected EBITDA is $1.9 million according to our forecast, and we've got a valuation range between 4.75 and 5.25 times. So we're going to call it 5 times cash flow, and so $1.9 million times 5 gives you an enterprise value of $9.5 million. Equity value, we know, is a simple formula. So we take that enterprise value of $9.5 million. We're going to back off the debt of $3.25. We're going to back off the preferred stock of $1 million, and then add back the unrestricted cash of $150,000. So we've got an equity value at the terminal equity value at the end of our investment holding period of $5.4 million according to our projections. Step 5 is the amount that's required from the warrant for the targeted IRR. So here, since we know the face amount of the preferred, we know the dividend rate, we know that it's current pay, we back into the amount required from the warrant to achieve the targeted IRR. So here you can see a real simple little spreadsheet, and it's just spreading out the cash flows for the term of our offering. And the 2.29 million there in year 5, that's the amount that's going to be required from the warrant to get us to a 35% IRR. So in Excel, if you go under Tools, Goal Seek, there's a real simple little tool in there that allows you to just put in a couple numbers, and then you're able to it'll just spit out what that number is, or you can just do it manually and keep plugging in a number till you hit your IRR. That's in our case 35%. So percent of equity. So now that we have all these components and these pieces for the formula, it's pretty simple. It's just a division problem. So the equity give up for this offering is the 2.29 million. So that's the amount that's required from the warrants to hit a 35% IRR, given the $1 million preferred and 12% dividend. That's current pay. And we know that the terminal value of the equity is 5.4 million. So that quotient gets us to 42.4%. So your warrant that you'll need to provide the investors to get them their return is 42.4%. So again, in conclusion, it's a pretty simple formula. And if you don't want to do this by hand, we've got a real nice little equity pricing model. It's real simple to use, and it quickly will allow you to run through different scenarios, so you can see how much equity you need to give up if you change your dividend rate, or if you make it current pay or PIK. It also provides IRRs for both preferred and the common. And so if you want to take a look at this, go to transcapitalpro.com/equity-pricing-model.html. This is Nick Jevick with Trans Capital Pro. Thanks for watching.